Andrew, we all know that you are passionate about investing, but we would also like to hear a little bit more about you. What makes you tick and what do you love?
Hi, I'm Andrew Wellington. I'm the founder and chief investment officer of Lyrical Asset Management, and I live in New York. With a name like Lyrical, it shouldn't be a surprise that one of my biggest loves outside of work is music. Music's always been an important part of my life, especially my teenage years. I would listen to music for hours and hours in my room, playing records. I'm a little bit too old. We didn't have CDs yet back then. That wasn't until college. As I've gotten older, it's continued to be something that I just love. The thing I love the most actually is live music, going to concerts, seeing shows. A lot of people ask me, did I ever want to be in a band? Yes, I did. Unfortunately, I have absolutely no talent when it comes to creating music. I can't sing, I can't play guitar, I don't play drums. The only keyboard I can operate is the one on my laptop when I'm building spreadsheets. So don't invite me out to karaoke night, but if there's a good band playing at the bar down the street, let's go.
Most people do not arrive at their chosen career through a direct path. So tell us, how did you end up as an investment manager?
I didn't start my career in investing. I started in management consulting, where I got to see how companies work from the inside out. And I spent 5 years doing that. And then through a twist of fate and a bit of luck, I got an opportunity to go be an analyst, working for one of the best value investors of his generation. As an analyst at that firm, I was assigned the stocks to analyze. Some of those companies were good businesses and some of those companies were bad businesses. And I noticed that when I analyzed the good stocks, I was right a lot more often than when I analyzed the bad stocks. And I got to the point where I didn't want to analyze the bad stocks anymore. They made me look stupid. I wanted to just analyze the good companies that made me look smart. That became part of my investment approach when I got my own portfolio to run. I got a new opportunity to go to a big firm and take over one of their products. There, I was able to combine some of the elements that began to form the way we do things here at Lyrical. I focused on this combination of value stocks that was also good businesses. Anytime you work for a big firm or you work for somebody else, there's always compromises to be made. I didn't want to make those compromises anymore. And the only way you could do that is to start your own firm. And that's what we did about 17 years ago. We created Lyrical Asset Management to put this investment process and philosophy into practice exactly how we saw best. And that's the way we've been doing it ever since.
Could you give us a little bit more insights into what makes your investment process unique? In essence, share with us how Lyrical works.
There's a lot of different ways to invest in the stock market. At Lyrical, we're value investors. You can think of us as we're the bargain hunters of the stock market. Some investors like to chase the latest trends or the hot new thing. We sift through the market and look for those stocks that have been ignored or been missed. And as a result, we can get really good businesses at really cheap prices. And value investing is a lot about what price you pay. You could take a great business. You could take the best business in the world. But if you overpay for it, you're gonna get a bad return. All of our investments have three specific traits. We summarize this with VQA. Those three traits are value, V, quality, Q, and analyzability, A. So it starts with value. We want to buy companies at bargain prices. Buying a company at a fair price gives you an average return. The way we get an above average return is we try to buy companies at bargain prices. That said, I've been doing this for almost 30 years, and every company I bought, I thought I bought at a bargain price. And a lot of them have worked out, and unfortunately, some of them haven't worked out either. So what separates the ones that work out and the ones that don't? What it really comes down to is whether the future earnings of that business end up being about what we expect it to be. So some companies, it's just easier to get it right than others, and that's where quality comes in. One of the most important things in getting the future earnings right is the kind of company you're trying to get the future earnings right about. When we avoid the lowest quality companies, we avoid a lot of mistakes. So that's value, that's quality. The last thing is analyzability. Some businesses are just too complicated. And I don't know if we or anyone else has any chance of getting them right. Things like banks or pharmaceutical companies, they're just incredibly complex. We owned a bank. This was in the aftermath of the financial crisis. that bank ended up being by far our worst investment of 2009. Now luckily, 2009 was a great year for us, and that one bad investment only made our returns a little bit worse. I probably know the banking industry better than I know any other industry, and we did a lot of research and analysis on that bank. We knew everything we could know about that bank. We had a financial crisis in '08, and even in '09, the banking industry experienced all kinds of turbulence that was very hard to forecast. Investing is a business where humans are making predictions about the future, and humans make mistakes and nobody knows the future. It's not about having no mistakes, it's about having as few as possible. And one of the ways we minimize the mistakes we make now is we only stick to the most analyzable companies. We stay away from those things that are too complex or opaque. It's really hard as an analyst to get that stuff right. On the other hand, if you search really hard, you can find that there's some really good, simple businesses available at bargain prices.